Do the markets still care about U.S. inflation data, or now that we're through all of the Fed speaking and the going back and forth on what the outlook is and what it should be, and rattling through all the various headwinds that the markets surely already know about, from the war in Ukraine to the potential for another government shutdown to this and to that, have we priced it all in already? Or is there still something that's lurking around the corner when the Fed's PCE numbers, the ones that they care about so much, the ones that are their favorite inflation gauge, do they still have some market moving potential? That'll be the question that we ask ourselves today as we survey stock markets having a chipper outing into the end of the week here, and seemingly a bit of a sense of relief after what has been a difficult few weeks for markets. Welcome. This is, of course, Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. What we're going to do here, and this is going to be a little bit on the nerdy side, so if you're watching this on YouTube and you have questions or you have comments on the kind of deep dive of the analysis that we're doing here, by all means, type those comments in. If you have questions, comments about what all of this means, the market implications, by all means, share your thoughts and we'll incorporate them into the show going forward. We'll start with some stage setting and just understanding the basic expectations for what's coming and why, and then how that might be interpreted by markets into the end of the week here. So let's start with just the baseline here. This is what we're looking for. This, as you can see, is telling us that headline inflation, that's just the expected inflation rate, including all of the items in the PCE basket. This is distinct from CPI in really just the makeup of the basket and some of the ways that that basket is constructed. But as ever, we're just looking at a basket of goods and measuring it over time in terms of the price of the basket to see what inflation may be doing. So the expectation here is for the headline number to edge up. This would match what we saw in the CPI numbers for this same period. This time to rise from 3.3 to 3.5%. Interestingly, the core component is expected to come down. The core component excludes energy and excludes food, which tend to be more volatile. So whatever inflation we're expecting to see here overall looks like it's going to come from either food or energy, because absent them, inflation is expected to come down, not up. The makeup of inflation, as we can see here, is overwhelmingly on the services side of things. That's that yellow area here. And that's showing us goods. And you can see there's a little bit of yellow at the bottom now, showing that goods are now actually a disinflationary force on the overall because they are deflating. They are actually negative at this point. So the service sector is where it's at. That's the sort of dark gray bars there. So whatever increase we're looking for, one would surmise then comes from either energy or food. Which one it might be is not terribly difficult to tell. We can see that agriculture prices for the period that we're talking about here are generally steady, so it's probably not food. Whereas when we look at what's going on in energy, natural gas, of course, continues to be terribly beaten down, but crude oil has risen, and not surprisingly, we've seen a pickup in gas prices in tandem. So whatever increase in inflation there is here, it seems to be coming from higher oil and thereby higher gasoline. That appears to be what's going to drive the pickup. Now, from the Fed's perspective, there's not a whole lot that one can do about that. Energy prices are set on global markets. There's relatively little that the Fed can do, at least in a pinpointed way. Now, the Fed's efforts to manage overall economic performance, to manage overall credit conditions, that's likely to have echo into energy prices indirectly, along with its influence on economic growth overall. But it isn't exactly much of a target for policy to aim at, because we're talking about secondary, tertiary effects here. There's not really much that the Fed, from the monetary policy side of things, can do about rising crude oil. So there's really not much agency there. The focus has to remain, one would think, on the service sector. So although whatever increase we might get here in the headline number might not be coming necessarily from there, might actually be the good side getting less negative because of energy, the situation for the Fed still lives in services. And there, it's an interesting exercise to look at where inflation is actually coming from. So here's the main sector, which is household services. This is overwhelmingly where service sector inflation lives. And here's what that area is made up of. As you can see, it's mainly housing and utilities. So the cost of housing, the cost of utilities. And in there, housing is overwhelmingly the one that matters. Utilities are a pittance in relative terms. The overwhelming way, then, that service sector inflation is held up is by the implied cost of housing. In other words, what the Fed does in looking at this, or what it sees when it looks at this, is the sort of shelter type component and the costs associated. Now, in this particular case, again, the Fed runs into a situation where there's not really much that they can do. And in large part, it's because the stickiness in housing is their own doing. If we take a look at what's going on with housing markets at the moment, we find that the rate of interest on outstanding mortgage debt is on average about 3.6%, whereas a mortgage that could be obtained in the market, thanks to the Fed's aggressive rate hike cycle, is something like 4% higher. That, of course, means that if you're a homeowner, you're going to be very reluctant to sell, because you don't want to then go out and finance your next place where you're going to live 400 basis points more expensive. You're going to do everything you can to not sell. That, of course, means that inventories are at some of the lowest levels we've seen in decades. Barely over 1 million existing homes. And by the way, existing homes dwarf what happens for new home sales by a factor of somewhere between 4 and 5. So we're talking about less than 1 million new homes sold over the course of a given month, and something on the order of 4 to 5 million existing homes. So it's existing home inventory that really matters at this point. And as we can see, it has been pulled down to levels that we haven't seen in at least 20 odd years. So it's not surprising that the price of housing is stuck at elevated levels. Nobody is selling. One would need for there to be selling in order for the price to come down. One would need for there to be some liquidity in this market. At this point, it is exceedingly tight. And so it's not surprising, given these conditions, that we have this very sticky piece in services inflation, but without rate cuts that the Fed certainly has no interest in doing because it still has an inflation issue, that's probably not going to get meaningfully unstuck. And so you then have to consider where the Fed can actually have some agency to start to have an impact to actually get inflation down. Because, of course, we're still aiming for a 2% goal. And with this coming out north of 3%, again, here's our expectations. Core inflation 3.9, headline 3.5. We're still well above target. The mission for the Fed is, of course, to continue to keep inflation coming down. That leaves the labor market. In the labor market, we can see that there's stickiness in the adjustment for the price of labor. That's the ECI, the Employment Cost Index, in the yellow there. That is greater than what we see in inflation. So we can see headline PCE here has come down from 7% to sub 4, whereas the Employment Cost Index has come down by less than 1%, from 5.1 to 4.5. And the stickiness there has largely been the imbalance, the lingering imbalance post-COVID in the labor market, labor supply, labor demand. We can see here the blue bars there, still showing us a deficit of close to 3 million jobs. And the way that we compute this is we look at labor supply as the number of people in the labor force, and labor demand as the number of people employed plus job openings. The labor force, of course, includes the employed and the unemployed as well. And right now, the supply of the employed and the unemployed is at a deficit relative to those employed plus job openings. So, essentially, from the Fed's perspective, the thing it can do, the place it can have impact, is to encourage a resetting of some of these wage agreements that were locked in during the height of this deficit, perhaps a year ago, let's say, where the deficit was closer to 6 million workers. And that deficit, of course, encouraged businesses to compete for workers on the only factor that they really can, wages, and lock in wage agreements relatively higher and give us that very spirited rise in wage growth and in employment cost that we see right here. So, from the Fed's perspective, the thing it can actually do is to squeeze the economy, encourage some amount of softening in the labor market, and hopefully it's the right amount of softening in the labor market so as not to cause any unnecessary pain, but essentially to trigger enough layoffs to have a reset of wage agreements that allows this market to adjust down and for wages to adjust down. Just enough that inflation is unstuck to a substantial enough degree. And so this is the sort of storied soft landing that everybody is perpetually hoping for, to essentially cool the economy just enough, but not too much. And so this is really where the market impact of these PCE numbers lurks, in so much as this is what the Fed is looking at and what it is considering when it is giving thought to, do we need to hike more? When do we cut? Should we cut more? Should we cut less? Should we cut sooner or later? And that's the primary object of speculation, seemingly, now in markets. Now, from the Fed's perspective, we just saw them opt for a pause at the latest policy meeting in September. They're looking at this and they're saying, okay, well, leading economic data would seem to suggest that the economy is already nearing standstill, if not at that level already. This is, of course, the latest PMI data from S&P Global, and I think it captures, it's a good catch-all for what you might see here as the sort of baseline state of affairs, the baseline for economic activity dynamics. It would seem that manufacturing is still in contraction mode, though at a slower speed. As ever, PMI numbers work around a center line of 50, where above 50 is growth, below 50 is contraction. The further you go in each direction, the faster rate of change is implied. So if you go above 50 and further above 50, that's faster growth. If you go below 50 and further below 50, that's faster contraction. So manufacturing here seemingly still in contraction territory, but less so than it was, less dramatically so. It's shrinking slower than it was a few months ago. But the key for the economy, as ever, is the service sector. It's amounting to something like 3/4 of the overall economy. So not surprisingly, when there was a burst in service sector activity at the start of this year, the overall economy got a lift. That lift seemed to have crested in May. And what we now see is a slowdown to essentially near idle at 50.1 on the composite reading. With that in mind, it seems the Fed has said, okay, we've driven the economy to standstill. It takes about 12 to 18 months for one of our rate hikes to be fully absorbed based on our analysis. We hiked furiously just about 12 to 18 months ago. So this should be getting absorbed in its full sense right around now, and lo and behold, the economy is near standstill. Let's pause and let's see if the amount of pain that we've dialed in is the right amount of pain. And let's sit on our hands here and let this now start to happen more concretely with the amount of pain that we've dialed in being sort of fully onboarded into the economy. And so, if you look at the latest set of Fed economic projections, you get a sense for just how long they intend to sit. The average Fed funds rate for this year, seen at 5.6, essentially endorsing the idea that we're basically done with rate hikes for this year. And then for next year, an upgrade from the June projection of 4.6 to 5.1. So as of the latest Fed update, they're saying we're okay to sit on our hands at this point and let this happen. but we are going to do less to unravel the tightening. We're going to have to sit on our hands longer before we give any reprieve than we thought when we did this exercise in June. The markets, for their part, are dubious. So if we look at where the expectations sit currently, we can see for the next meeting in November, it's a 20% chance of a hike, so chances are it's not going to happen. For December, it's about another 20% chance that there's a hike. So here we are, November, 20, December, about 20. That's a cumulative 40% chance that there is a hike at one of the two remaining meetings for the year. Obviously not exactly a commanding sort of outlook. And then as we get into the middle of next year, we start to see cuts. So it looks like we have at least one cut in by July, a second one in by November of next year, and then about a 60% chance for a third in December, with that third fully there come January of next year. Now, of course, these are looking relatively far out, but the key thing to have in mind here is this number. So by the end of next year, the market is anticipating that we're going to be at 4.6%. And if you look at what the Fed is saying, they're saying 5.1. In other words, it looks as though the market hasn't made this adjustment. They think the Fed is going to have to be easier. They think they're going to be able to hold out before raising rates for a shorter period of time, perhaps, than what the Fed is now anticipating. This, of course, sets up a very interesting dynamic for the PCE report, because as we've just looked here, there really isn't anything that has changed from the Fed's baseline view here that would get them to stop. At the very least, from the wait and see position that they've adopted. They now need to just let this process go, it would seem. Or at least that's the abiding message. And as long as we still have room to continue to unwind this part of it, we don't necessarily have the motivation for a Fed to get off its horse, as it were. So if what occurs here falls broadly in line with expectations, then we are left with much the same thing after it than we did before, which is this is the breakdown in PCE inflation, give or take. The parts here where the Fed can have some sort of meaningful influence are the labor-related sectors. In those areas, the economy is already slowing, so there's probably not more rate hikes, but there may be a longer wait for labor to catch up. And so the disconnect isn't so much in that the data is going to give us anything new. It's that the markets aren't close enough to where the Fed is on what it means. And if the data offers something of a reminder, well, then we could very well be back into the kind of price action that we've seen in the wake of the CPI data showing us much of this, and then the Fed reaction to it being, of course, the FOMC signal of higher for longer that we got from this last policy announcement, all of which might well portend poorly for stocks, poorly for bonds, offer something of a lifeline for the US dollar after a difficult corrective day, and essentially return us to the price dynamics in markets that we were seeing about at the start of this week and at the end of last. And that is Macro Money for today. As ever, we are here Monday through Thursday every week, making this the last show of this week. I'll be back on with Macro Money right after Overtime, a show that I co-host with Chris Vecchio, head of Futures and Forex here at Tasty Live next week, Monday through Thursday as usual. We are increasingly graced with the presence of Dylan Radigan on that show, which is made for some really interesting conversations, so do check that out. I'm back on with Chris tomorrow for Futures Power Hour, as I am every Friday. I am then on with Tom and Tony for First Call. That's on Sunday evenings. Writing for the News and Insights portion of tastylive.com. In fact, a summary of this very analysis is currently published there. And finally, opining on Twitter, cue the music there, at Ilya Spivak. Thanks very much for joining. See you tomorrow for Futures Power Hour and next week for Macro Money.